Hello there, I'm Windermere Real Estate's Chief Economist, Matthew Gardner, and welcome to a rather special episode of Mondays with Matthew. Why special? Well, regular viewers of my videos will know that I generally take this opportunity to give you an update on the housing-related numbers that came out during the course of the month. But this time, we're actually going to go in a bit of a different direction. You see, a few weeks ago I was asked by the real estate publication Inman to pen an op-ed that would offer a counterpoint to this one, which they had just published. Well, I think that many of you will agree that this is a very direct position, and judging by some of the comments I read following its publication, was certainly one where readers were very firmly on one side of the fence or the other. So those of you that know me at all will probably have already figured out my position on this. So I went ahead and crafted my response, and I do take a somewhat different view on the matter. Anyway, as I'm sure some of you don't have access to Inman's website, I thought it might be interesting to share with you the reasoning behind my belief that we are not about to enter a period of declining home values. But even if you are an Inman subscriber and did read the piece, well, I hope you'll still find this video worth watching, as I will also be sharing some of the background data with you that was not included in the article, as well as to give you some more context on this particular topic. But to start with, it would be silly not to acknowledge the fact that home prices have been rising at a significantly faster pace than wages for several years now, and that may well be part of the reason why some people in the industry and some prospective buyers are getting just a little bit concerned. Well, as you can see here, since 2012, the average weekly wage has gone up by a little bit more than 30%, with the average annual gain of around 2.3%, which is actually not that bad. Our wages also rose by over 6% last year. Now that sounds great, but in reality, it was because of the pandemic. You see, most of the job losses were in low-wage sectors, which skewed the data upward. But I digress. Anyway, during the same time period, well, you'll see that even as wages rose, home prices have taken off, and wage growth simply has not kept pace. I often think about a quote from the Spanish philosopher and novelist George Santayana, which I think just about says it all. So what are we going to do today? Well, we're going to take a look back in history and run through a fairly brief timeline of events that led up to the bursting of the housing market in 2007. And then we're going to look at where we are today and how it's totally different. And that leads me to speculate there is really no real reason why we should anticipate any form of widespread systemic decline in home prices in the foreseeable future. The first chart I want to show you today is the Case-Shiller National Home Price Index level over time, and we'll be using it as a base for this part of the discussion. But if you're not familiar with Case-Shiller, it's what's known as a repeat sales index, which means that it looks at the change in sale prices between when a home was purchased and when it was sold. And it's a great way to look at changes in home values. All right, let's go back all the way back now to the early 1990s. And in 1992, Congress enacted Title 13 of the Housing and Community Development Act. And they did this with one reason, and that's to give low and moderate income borrowers better access to mortgage credit, mainly via loans that were supported by the GSEs, Fannie Mae and Freddie Mac. Moving on, in 1995, President Clinton, he introduced a national home ownership strategy. And that had a very aggressive goal, and it was to raise home ownership levels from 65.1% all the way up to 67.5% by the year 2000. And that would be a rate of ownership in America that had never been seen before. But this could only realistically happen if Fannie and Freddie significantly increased the share of mortgage funds going to these lower income households. Now, we just mentioned the Housing and Community Development Act. Well, that required Fannie and Freddie to dedicate 30% of their portfolio to lower income borrowers. But the Clinton plan, that meant they had to raise that share up to 42%. It started out rather well. Almost 2.8 million new homeowners were created between 1993 and 1995. And that was double that seen during the prior 2 years. And because of the increase in demand that would come from greater loan volumes, Fannie and Freddie moved to an automated underwriting process to speed up loan approvals. Now, interestingly, this actually became the industry norm, but in going to an automated model, all they really did was to significantly relax the underwriting approval process. Moving on to the very end of that decade, in November 1999, Congress passed and President Clinton signed the Gramm-Leach-Bliley Act. Now, this act, amongst other things, well, it lifted most of the restrictions that prohibited any one financial institution from acting as a combination of an investment bank, a commercial bank, and an insurance company that were prohibited. And they were prohibited because of the Banking Act in 1933, otherwise known as the Glass-Steagall Act. Now, this is important because, in essence, banks could now underwrite and sell banking, securities, and insurance products and services, which included, you guessed right, mortgage products. In 2000, the dot-com bubble burst, something those of us here in Seattle remember all too well. And one of the major consequences of this was that investors moved away from the equity markets and instead turned a lot of their attention to the real estate market. By the start of 2001, the country was heading into a recession, although it was going to be fairly short. And even though the unemployment rate remained close to a 30-year low, the Federal Reserve wanted to stimulate more borrowing and spending. So they started to lower short-term interest rates very, very aggressively. In fact, 11 times in the course of that year. And as you can see here, over the next 3 years, the market jumped, with home prices rising by 7% in 2002 and 7.5% in 2003, as more would-be homebuyers found easier access to mortgage credit, not just from Fannie or Freddie, but all of the other institutions that can now get into the game following the passing of the Gramm-Leach-Bliley Act. And because of its success, the push to expand home ownership that started under President Clinton continued under President Bush. And he introduced a zero down payment initiative. Now, that allowed, under certain circumstances, a removal of the 3% down payment rule for first-time homebuyers using FHA-insured mortgages. The Bush and Clinton administrations saw their housing goals achieved, with the home ownership rate increasing steadily and peaking at 69.2% in 2004. Ownership rates and rapidly rising home prices were driven by one thing. Home buyers were consuming, with relish, I might add, rare mortgage products with strange-sounding names such as Alt-A, Subprime, IO as in interest only, Low Doc, No Doc, or the classic Ninja loans. Ninja being an anachronism for no income, no job, no assets. There were also 228 and 327 loans, liar loans, piggyback second mortgages, payment options, and even a pick a pay date adjustable rate mortgage. What could possibly go wrong? And by 2005, subprime mortgages had risen from 8% of total loans made in 2003 to 20%, with about 70% of subprime borrowers using the hybrid 228 and 327 arms I just mentioned. And these were mortgages with very low teaser rates for the first 2 or 3 years, and then they adjusted normally upward periodically. And when you add in Alt-A mortgages, well, the total share of just these two mortgage products rose from 10.4% in 2003 to 39.4% in 2005. Many people chose their financing poorly. Some clearly wanted to live beyond their means, and by mid-2005, nearly 1/4 of all borrowers across the country were taking out interest-only home loans. That gave them a lower monthly payment, but why? Well, they weren't worried about paying down any of the principal because home prices, well, they were going to continue to skyrocket forever, right? By the end of 2006, a full 90%, that's 90%, of all subprime mortgages were ARMs. And with a doubling of the subprime share, about $2.4 trillion of new subprime and non-prime mortgages were used to buy homes. In 2007, over $1 trillion worth of ARMs were about to reset. And this is really what took the market down. Why? Well, remember back in July of 2004? Well, the Fed started to raise interest rates. And with all the ARMs starting to reset, a massive number of homeowners, well, they realised they just couldn't afford their new payments, which in some instances were going to double. And they started to default in droves. The ultimate outcome was that in 2010, over 2.2% of all homes in America were foreclosed on. That's almost 2.9 million homes in just 1 year. All right, that's the history lesson. So now let's compare and contrast where we are today with what happened back then. As we discussed earlier, the Fed started to lower interest rates following the dot-com bust, and that flowed down to the mortgage market, and rates also started to drop. But it wasn't just the Fed. Investors did what they usually do during periods of economic uncertainty. They moved a lot of money into bonds, and this has a far more direct impact on mortgage rates. By 2004, mortgage rates had dropped to a record low. And as rates dropped, look what happened to prices. They started rising as buyer purchasing power rose. But that's far from the only reason why home prices rose so significantly, but we will get to that later on. So as we move forward in time to now, you can see that rates, well, they dropped again as the financial crisis was taking hold and the country was entering a recession. And rates dropped even more starting in 2019. And that was when the Fed was starting to become concerned about inflation, slowing global growth, and trade wars. And as we all know, they offered further support to the housing market at the onset of the pandemic by aggressively buying bonds, which effectively lowered mortgage rates even further. So far, you may well be thinking, well, it's clearly the same as last time, but I'm afraid that you would be wrong. You see, although sale prices certainly surged in 2013, realistically because home prices overcorrected on the downside following the bubble, average annual price growth since 2013 has actually been slower than we saw pre-bubble. The median sale price rose by an average annual rate of 7.6% between 2000 and 2005, but between 2014 and 2020, the pace of appreciation was a full 1.5 percentage points lower. I'm going to talk more about mortgages shortly, but it is important to touch on another significant difference between the 2000s and now, and that's home supply. As you can see here, starting in 2001, inventory levels rose and peaked just as the bubble was about to burst. Why? Well, do you remember me telling you about the surge in unique mortgage products, specifically those ARMs? Well, 1 in 10 borrowers in 2005 and 2006 took out option ARM loans, and 1/3 of ARMs originated between 04 and 06 had teaser rates below 4%. Therefore, we started to see people try to sell before the rate reset, and this led to a massive increase in home listings. But how does that compare to what we've seen over the past several years? Looks different, doesn't it? The number of homes for sale has been sliding since the spring of 2011, and it's currently at the lowest levels since data on total US listings started to be gathered back in 1999. Ultimately, the basic economic laws of supply and demand, well, they're working today. Prices rise on scarcity of product and lower cost of financing, both of which we see here. Now, this shows the average number of existing homes that were for sale in the spring of 2005. That's a date I chose as it was before mortgage arms started to reset. And I compared that to this spring. Clearly, a very significant disparity. Now, of course, some of you may say that it's lower because of the pandemic, but even if I were to use the spring of 2020 as a comparison point, before the pandemic took hold, listings would still be 36% lower than they were in the spring of 05. Now, new demand can be met by building more new homes. Almost 1.7 million single-family permits were issued in 2005 when the market was booming. But fewer than 1 million single-family permits were issued last year. On the multifamily side, well, that's a little bit more complex, as we can't distinguish between what's going to be built as an apartment and what's going to be built as a condominium. But I would suggest that although the number is pretty close to identical, the difference is that new multifamily permits last year were focused on the apartment world, whereas they were mainly condominiums back in 05. With low levels of existing and new homes for sale today, prices have risen significantly, no doubt. But the difference I see is that during the pre-bubble years, prices were climbing more as a function of speculation rather than real demand, as there were significantly more homes available back then. And another reason why housing supply has been so weak is that we are simply not moving as often as we used to. Speculation drove home buyers to move on average every 4 or so years in the early to mid-2000s. But look at more recent years. Mobility has dropped, and we now live in our homes for twice as long as we used to. And this further limits housing turnover, which, with the relatively low levels of new construction we've just discussed, also puts upward pricing pressure on housing as supply levels stay very low. On the demand side of the equation, census data shows that 3.8 million new households were formed in the United States between 2000 and 2006. That's a pretty decent enough number. But between 2014 and 2020, well, we added 10.5 million new households. Of course, not all newly formed households become home buyers. I totally understand that. But we know that the long-term average home ownership rate in America is around 65%. So it's easy to extrapolate the numbers and conclude that demand for ownership housing continues to far exceed supply. And talking about the ownership rate, well, some think that it's rising too fast. And that is further proof that a speculative bubble is in place. But look at this. The pre-bubble period saw the ownership rate start to skyrocket, ultimately hitting an all-time high in 2004. While the rate was still elevated in 2010, it didn't reach a low until 2016. But even though it has risen since, it remains well below the level that we saw back in 04. If you're wondering about the 2020 spike, well, I would take that with a pinch of salt. I say this as a Census Bureau survey on the first 2 quarters of last year. Well, the numbers were significantly impacted by COVID-19 and the way the data was gathered. And I believe that the home ownership rate in those first couple of quarters was significantly overestimated. In fact, data for the first quarter of this year, well, it shows the ownership rate at 65.6%, far more realistic. So I think that this clearly shows that although we continue to add new households, we've not seen a speculatively driven spike in the ownership rate that would be similar to the one that we saw when the housing bubble was forming. Well, so far we've looked at the supply of homes and how that's impacted increasing housing prices, how demand continues to rise as more new households are formed, and we've also covered the impact of mortgage rates and how they change the market in terms of increasing home prices. I promised you earlier that we would be returning to the financing side of the equation because it's clear to me, and should be to many others, that this was the chief culprit behind the housing bubble. This chart shows the median credit or FICO score for home buyers approved for a loan, and you can see the significant drop in credit quality that occurred in the early to mid-2000s. But look at where we are today. The median credit score is now 788. And when we look at the number in a little bit more detail, well, it's even more remarkable. By early 2007, the riskiest borrowers, those with credit ratings below 620, they were borrowing 15% of all funds used to buy homes, while prime borrowers, the good guys, well, we were just below 24%. But again, look at where we are today. The subprime share of mortgage borrowing has shrunk to just 1.4%, while prime borrowers, well, they are now at a very solid 73%. The bottom line is that credit quality is remarkably high and not at all like the pre-bubble period. Also earlier we discussed that between 2001 and 2007 mortgage debt doubled, and much of this growth came via risky mortgage products, many of which, as we've just talked about, were adjustable rate mortgages that offer the buyer significantly lower monthly payments. Now, ARMs accounted, this is total ARMs, and not just subprime, accounted for 35% of all mortgage borrowing in 2004, but the current share is far lower, which should, I hope, quell any concerns there might be a wave of ARMs resetting that could impact the market if we start to see rates rise significantly. And as you can see here, the share has dropped precipitously. It has leveled off over the past few months, and it did rise modestly in March, but certainly not to a level which is, at least for me, concerning. Now, this is data from the Urban Institute, and I use these guys' numbers regularly. It's their Housing Credit Availability Index. Now, this index, what it does is it calculates the percentage of owner-occupied home purchase loans that are likely, not guaranteed, but likely to default. That is, go unpaid for more than 90 days past their due date. I like this also because their methodology also weights for the likelihood of economic downturns as well. Now, a lower HCAI indicates that lenders are unwilling to tolerate defaults and are imposing tighter lending standards, therefore making it harder to get a loan, while a higher percentage suggests that lenders are willing to tolerate defaults and are taking more risks by making it easier to get a loan. Now, lenders were all good taking risks in the bubble days, but they're certainly looking at things very differently now. The bottom line is that even if the current default risk doubled, it would still be well within the pre-crisis standard that we saw between 2001 and 2003. And this chart, well, it shows loan-to-value ratios. And again, it's interesting because as the bubble was forming, the ratio went up as buyers were getting over-leveraged, borrowing more, lower down payments. But look at where it is now, well below even the pre-bubble levels. Again, tight credit and significant equity puts us in a very different place than we were in the 2000s. Now I'm going to share some forbearance data with you, and I'm doing it for one reason, and it's because I've heard from several brokers who have told me that they have clients who are thinking about waiting to buy as they believe that homes in forbearance will end up in foreclosure, and the growth in supply could lead home prices to drop across the board, or at the very least allow them to pick up a home on the cheap. But as you can see, the number of homes currently in forbearance, it's down by over half from its May 2020 peak, and that equates to 2.6 million homes having come out of the programme successfully. In fact, even if all the homes still in forbearance ended up in foreclosure, well, it would still only represent a fraction of the nearly 10 million homes that were foreclosed on due to the housing bubble bursting. And when we look at the share of total homes in forbearance, well, it peaked at just over 9%. Now it's knocking on the door of 4%, and it's, I believe, going to go lower. You see, there's 250,000 more homes in forbearance that are about to hit their forbearance period. And I anticipate that the numbers will drop further, likely starting later this month. So why am I not worried that a large share of these homes will be foreclosed on? Well, this is why. You see, in the first quarter of this year, homeowners were sat on over $21 trillion in home equity. Massive figure. And you can see the build-up of equity as a housing bubble was forming, and then it contracted through the housing crisis. However, since 2012, home equity levels have more than doubled. And my friends over at Atom Data Solutions, well, they created analysis that estimated that in the first quarter of this year, almost 1 in 3 homeowners in America had more than 50% equity in their homes. That's almost 18 million homeowners. And this tells me that a lot of owners in forbearance who just can't get back on the right path, well, they still have the option to sell their homes in order to keep the equity that they have, after the bank is made whole, of course, rather than go through the foreclosure process. But it's not just this company that thinks the same way. Further support comes from the folks over at CoreLogic. Now, they recently put out a paper, and it's really interesting reading actually, and it suggests that about 42% of all owners in forbearance, well, they bought their home before 2012, and they have, unsurprisingly, built up a significant chunk of equity. The median equity level, even after they cover any missed payments by being in the forbearance program, almost $100,000. Of course, it's reasonable to suggest that this may all sound good, but what about owners who didn't buy a long time ago and therefore have less equity in order to get themselves out of trouble? Well, their data shows that 43% of owners in forbearance bought between 2013 and 2018, and they've also benefited from prices rising. They've got an average of more than $87,000 in equity, again after accounting for missed payments. And even the newest owners, those who purchased their homes in 2019 or even later, now that's about 15% of all homes in forbearance. Well, they've still got an average, believe it or not, of over $65,000 in equity. The bottom line here is that, in broad terms, a typical homeowner in forbearance could, with relative ease, cover the costs of selling their home and still have equity left. Will foreclosures rise this year? Of course they will. But given all the facts I've shared with you today, well, I see it as being more of a trickle rather than a flood. There you have it. As far as I can see, all the data points to the fact that we are in a very different place today than we were back in the 2000s. And I'm afraid I just find it highly unlikely that we will see a repeat of the events that we saw back then. Down payments significantly higher, credit quality significantly higher, and demographic demand for ownership housing is still very robust. And in my opinion, is actually only going to get stronger. Why? Think millennials. They continue to reach prime home buying age. There's going to be 9.6 million millennials turning 30 over the next 2 years alone. And they do want to buy homes. But as I said in my opening comments, the pace of price growth that we've seen over the last year, certainly, well, it's clearly unsustainable and it must start to slow. Now, if only to allow incomes to start catching up. In fact, I'm already starting to see some tentative signs of this occurring, with the pace of growth in list prices, not sale prices, list prices starting to soften in several markets across the country. And as this continues, that will likely ease the pace of sales price growth as well. But I'm afraid that I just don't see a national downturn in home values occurring. That is, unless banks decide to significantly loosen their underwriting criteria again. But I'm afraid I find that very hard to believe. Well, thank you for sticking with me during this rather long video. I do hope that you found it to be at least of some interest. As always, if you've got any questions or comments about today's topic, please reach out. I'd love to hear from you. In the meantime, thank you again for watching. Stay safe, please. And I look forward to visiting with you all again next month. Bye now.